Welcome back to Alpha Recap. I'm Brittany. Today, we're breaking down a pretty sharp risk-off session after the close, and we've got Drew here to walk through what moved markets. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to unpack from the close. Oil, geopolitics, tech weakness. The market definitely digested a bunch of headlines today.
Let's start with the big picture. The indexes closed lower across the board. The broad S&P finished down about 1.7%. The tech-heavy Nasdaq finished just under 2% lower. And small caps slid about 1.75%. Big move.
Yeah, that tracks. Those numbers painted a clear risk-off day, where growth and higher beta names took more of the hit.
So, what really stands out here is the catalyst mix. Oil spiked on an Iran-related supply scare, and that seemed to kick everything off. Drew, walk us through how a move in crude translates into this kind of market action.
Sure. At the simplest level, when oil jumps, it raises the odds that inflation prints stay higher, at least for a bit. Higher inflation makes the Fed's job trickier, and that tends to hurt long-duration assets. Think big tech, because their future profits get discounted more. So a crude shock can turn a tranquil market into a sell-first environment pretty quickly.
Right, and beyond the inflation channel, we saw headline-driven flows into energy names. Energeo performed intraday, while the rest of the market faded.
Exactly. Traders chased commodity exposure and re-rated some service and producer names higher. But the energy-led gains weren't big enough to offset the losses across other sectors. Honestly, I was a bit surprised by the breadth of the selling. Small caps ended up down nearly as much as the S&P, which signals the weakness wasn't just in the mega-cap growth names.
And to add to that, there were other headlines that amplified risk-off. Renewed regulatory scrutiny in crypto and signs of softening demand in cyclical pockets. That combo pushed flows away from rate-sensitive and long-duration assets.
Right. Crypto headlines seem to trigger selling in exchanges and miners, and that bled into related small-cap names. So you had both macro and micro drivers in play at once.
Technology bore a lot of that selling pressure, which is notable because tech often leads upside. When those names stumble, it tends to have an outsized effect on indices.
Think of it this way. Large-cap growth stocks are like a heavy weight in market cap-weighted indexes. When they drop, the headline number looks worse, even if lots of stocks are flat. But in today's case, breadth actually deteriorated. Smaller domestic names were down too, so the weakness was broader.
Let's walk sector by sector. Energy was the clear relative winner. Communications and media had pockets of strength too, partly on M&A chatter and ad recovery hopes. Utilities and real estate, though, felt pressure thanks to rising rates and the general risk-off tone. Materials were mixed. Industrials lagged. Consumer was weaker on the idea that rising oil acts like an indirect tax on spending. Financials also traded under pressure.
Yeah, that captures it. Financials were sensitive because higher oil and inflation muddy the Fed outlook, and banks watch the short end of the curve closely. So ambiguous Fed signaling plus a possible inflation bump is not ideal for financials today.
We also saw some company-specific stories cutting through the noise. AstraZeneca jumped roughly 4% after a surprise clinical win. That was one of the clearer idiosyncratic winners.
That was a classic reminder that even in a down day driven by macro, company news can produce outsized moves. Same with O'Reilly Automotive getting a positive analyst note. It held up better than others in the retail auto aftermarket group.
Short reactions. Quick ones, right?
Right.
Yeah, absolutely.
On the technical side, internals looked shaky. QQQ's bigger drop relative to the S&P suggested growth leadership was wavering. Declining breadth, heavier sell-side volume, those are textbook signs of distribution.
Explain for listeners what breadth deterioration means in plain terms.
Sure. Breadth simply measures how many stocks are participating in a move. If only a few names are down and most are flat, breadth is strong. If lots of stocks are dropping, breadth is weak. Weak breadth tells you the market's decline is broad-based, not just a handful of laggards.
Good, that helps. And volatility metrics rose too, as traders sought optionality to protect against more downside surprises.
Right. Options activity picked up, and VIX-like measures ticked higher, which is typical when people want hedges in uncertain environments.
Let's talk Fed implications. Analysts noted 3 key policy takeaways from today's price action. 1. Higher oil increases the risk that inflation stays stickier. 2. Policy uncertainty broadened because the market now has to price both inflation and growth risks. And 3. Banking and funding dynamics stay sensitive to how the short end of the curve moves.
Yep. In plain language, if oil stays elevated, the Fed might be less inclined to pivot toward easier policy quickly. Alternatively, if growth softens because higher energy costs sap demand, that flips the script. Markets are pricing a wider range of outcomes, which increases volatility.
So what should listeners be watching heading into the next session? Number 1. The oil price trajectory. Whether this was a one-day headline spike or the start of a sustained move. Number 2. Fed speakers and the minutes that might clarify tolerance for higher inflation. Number 3. Economic prints on inflation and labor. Number 4. Corporate catalysts like earnings and trial data. And number 5. Crypto and regulatory headlines.
Add to that, pay attention to follow-through. If oil keeps rising tomorrow, the risk-off mood probably extends. If oil cools and headlines quiet down, we could see a snapback in oversold tech names. Historically, markets often overshoot on headline-driven moves.
Quick reaction segment. Short ones now. Big move on oil today.
Not what anyone expected.
And a quick note on the crypto angle. Renewed regulatory scrutiny pressured exchanges and miners, which fed into the broader risk-off. That was a tail risk that traders priced in pretty quickly.
Crypto is still very sentiment-driven and sensitive to policy headlines, so it often amplifies market moves rather than being a primary driver.
Final takeaways. 1. It was a broad risk-off day with tech and small caps leading the declines. 2. Oil's spike on an Iran-linked development was the proximate trigger, and it complicated the inflation and Fed picture. 3. Sector rotation favored energy and select communications names, while tech, financials, and crypto-related equities lagged. And 4. Near-term risk remained elevated. Keep an eye on oil, Fed commentary, inflation prints, and company-specific news to see if this repricing extends or reverses.
To wrap up, analysts note this sort of session often calls for shorter-term tactical positioning rather than big, long-duration bets until the macro picture clarifies. Again, this is market analysis for informational purposes only, not personalized investment advice.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. I'm Brittany.
And I'm Drew. Thanks, everyone. See you next time.